Payments is a thorny issue for many small businesses, or at least it used to be. And Shopify has made the process so much easier for them. And just to hit on it again, because whenever we talk about software companies, especially something as boring as enterprise software, it can all feel a bit abstract if you've never used the services yourself, which I haven't. But in short, Shopify is a platform designed for anyone to sell anything, anywhere, giving entrepreneurs the resources that for many years were only really reserved for larger corporations. And since IPOing in 2015, Shopify has shown just how powerful its platform is by growing gross merchandise volume revenue by over 50x.
To start today's episode, let's put on our Star Wars fan caps for a moment. If Amazon is the evil galactic empire, then Shopify is the rebels fighting back in the war for e-commerce. Amazon is this massive third-party marketplace for just about everything you could ever need to purchase, with unrivaled convenience and deals. And yet it forces merchants to sacrifice a lot of their brand autonomy to conform to Amazon's standardized checkout process, and also to accept Amazon's high fees for using its ecosystem, which are even higher when you consider that merchants typically have to pay to advertise on Amazon if they want to get any kind of meaningful visibility. Amazon helps brands with order fulfillment and gives them reach they may otherwise never have dreamed of. But in return, Amazon tries to turn them into commodities for the sake of making prices as low as possible. Given that something like 2/5 of all e-commerce in the US touches Amazon, you can see why some refer to them as being this empire that dominates the universe. Yet, Shopify enables any small business anywhere in the world to have its own all-in-one platform for managing operations and professionally overseeing e-commerce sales. So Shopify almost has the opposite approach, with a very democratized focus. While Amazon generally is trying to pull everyone onto its platform, Shopify wants to help brands build out their own distribution and sales channels. I know that's a pretty dramatic setup for our conversation today, but Shawn, you're here to tell us about the battle for the future of e-commerce and pitch Shopify, right?
Hey, Daniel. Yes, that is exactly right. And I'm excited for it. It's going to be a good one. Not only, as you alluded to, is Shopify a fascinating and really compelling company, but it is at the epicenter of this big power struggle for the future of e-commerce. And we will get into that more. And you described it as this rebellion of sorts, kind of like in Star Wars, which is probably a giveaway to how nerdy we both are. But that is exactly how Shopify has described this struggle themselves too. They are the rebels in this bigger battle for e-commerce.
Shopify is one of those companies I've always heard so much about, and yet I've never really had the chance or the time to dive deep into it and understand it to a level that I would want to. And for anyone else who feels kind of the same way, Shawn is going to change that for us today. So with that, why don't you just give us an overview of what Shopify exactly does?
The way I like to think of it is that Shopify is the world's leading cloud-based commerce engine. And as such, it enables small and medium-sized businesses and increasingly large enterprises to conduct commerce, with about half of its business coming from North America and the other half from the rest of the world. Its merchants can range from small mom and pop stores to brands like Heinz, Allbirds, and even Gen Z icon, Mr. Beast. But to take a step back, you're probably thinking, what does that buzzwordy term commerce engine actually mean? And in a nutshell, the Shopify platform enables merchants to design, set up, and manage their online stores, obtaining a single view of their business and all of their customers across multiple different sales channels, manage products and inventory, process orders and payments, build and enhance customer relationships, and perform analytics and financial reporting. And all of that in one place, available either via a desktop browser or an app on your smartphone. So the idea is really to imagine being able to run your entire business through a single platform. That is Shopify's value add. And Shopify is in the process of executing what you might call a textbook innovator's dilemma style disruption of the enterprise software market. They started with a cheap and relatively easy to use offering that mostly appealed to small businesses at the lower end of the market and was kind of created below the radar of companies like Salesforce and Amazon. And then over time, they've made it better and better until it started to become more competitive with traditional enterprise-focused alternatives. And as Shopify has scaled and become a more useful and also cheaper alternative for large corporate customers, they've been able to systematically solve every pain point a merchant might face in their daily operations of running an e-commerce company.
For the longest time, Shopify has benefited from the so-called innovator's dilemma. And the innovator's dilemma is this idea that successful, well-established companies often fail to keep innovating. Not because they are badly managed or anything, but because they're too focused on serving their current customers and protecting their existing business. When a disruptive technology or new business model appears, it usually starts small, targeting a different or a less profitable market segment. Big companies then often ignore it because it doesn't seem threatening at first, but over time that new innovation improves, captures more market share, and eventually overtakes the incumbents who didn't adapt quickly enough. Now, Shopify has been that innovator for quite a while, but today we're talking about a company worth well above $100 billion. So you might say it has become kind of an incumbent itself. If that's true, where do you see opportunities for continued disruption, and can Shopify still be the company to deliver that?
I think it's fair to say that every expense line item on a merchant's income statement is arguably an opportunity for Shopify to both help their merchants become more efficient while also capturing some of that value creation for themselves. Over the last decade or so, that has meant adding Shopify payments in 2013 so merchants can basically tick a box and be up and running accepting payments, or with Shopify shipping, or merchants can access these negotiated wholesale rates by utilizing shipping services via Shopify, or with Shopify Capital, where merchants can, if eligible, borrow money to fund their working capital needs, and even Shopify email, where merchants can create, send, and track their email marketing campaigns all through Shopify. And on top of that, you have all of these other really powerful yet simple tools like Shopify Markets, which allows merchants to, again, basically just tick a single box, and then all of a sudden they can sell their products in 100+ countries with embedded tools for website translation, currency conversion, local payment methods, and collecting local taxes, and all of which is automatically taken care of. So these are what you would call turnkey solutions, addressing a pretty wide range of services that businesses might need help with, especially those businesses that are selling e-commerce products globally. And it doesn't take much imagination to see why this is such a valuable value add that they're able to add.
On the one hand, having such wide range of simplified and streamlined services is great. And we have seen time and time again how these tech behemoths succeed with that. But it's also incredibly difficult to be good at everything. And coming back to the innovator's dilemma, once you stop being good enough, there will be another company taking your spot, focusing just on that niche and performing better. The best companies out there prevent that from happening by building moats around their businesses. And we will get to that, as we always do. But before we get to it, how about you tell us about the advantages Shopify had in disrupting the enterprise software and carving out their own niche?
Beyond the normal benefits of a software business at scale, where there's some stickiness with customers due to switching costs and also economies of scale and R&D costs, they're also accumulating a lot of valuable data on merchants and consumer spending, ranging from how merchants use marketing spending and promotions to seeing what products customers add to their carts and how long it takes for them to do so or to make a purchase. And Shopify can leverage all of that into making more useful products, which is sort of a subtle advantage over at least smaller competitors who might not have as rich of a body of data to try and glean insights from. Not to say that Shopify is immune from eventually being a victim of the innovator's dilemma itself, though. And of course, some companies are very adept at compounding their advantages and tackling the innovator's dilemma head on as much as possible. And Alphabet is one of those examples, and that's a portfolio company for us, Daniel. And it comes to mind because of that. And they have increasingly diversified their business over time and remained at the forefront of technology, And obviously, they have that other bets unit that kind of helps them directly take on the innovator's dilemma. So it cuts both ways. Shopify is a disruptor that it could eventually find itself being disrupted one day, but it can also learn a lot from companies like Alphabet, who have continued to further entrench themselves over time. And like I said, it's not difficult to get really, really bullish on how Shopify might do the latter. The fact that Shopify has this really robust app store ecosystem, which I'm sure we'll talk about more in a bit, is a testament to how they've basically built this platform that's a base layer that attracts others to come and build and innovate on top of. And so they're kind of outsourcing a lot of that work while still reaping the benefits of it, similar to how Apple has built the iPhone and then has benefited from third-party developers building apps on top of it that make the iPhone more valuable.
You definitely have to tell us more about the third-party ecosystem and also about the apps, because I think it's a major part of why Shopify has a good argument to make that they won't become one of those disrupted incumbents, although it doesn't have the same benefits yet as Google has, because they just produce so much cash that they can afford to have a others bets unit that Shopify doesn't yet have the money for. But in contrast to Amazon or all these other companies, Shopify is not competing with other merchants. It positions itself as a true partner, which of course incentivizes third-party sellers to then join Shopify and their ecosystem to help make it stronger. It's one of those self-reinforcing cycles that we see with all these successful tech companies. But if we take a step back for now, I know Shopify is a young company, but I refuse to skip one of our favorite parts of these breakdowns, which is the good old company history. So Shopify is a founder-led company. I know you like those. So let's talk a bit about that for a moment. Who is Tobi Lütke and how has he built Shopify into this $100 billion company that we know today?
As you said, Tobi founded Shopify in 2008 and has been its CEO ever since. As a lot of these software startup stories go, and we've talked about a number of them already, the origins were very humble. The story of Shopify, you might say, began in 2002 when 22-year-old Tobi Lütke, who moved from Germany to Canada and after being unable to secure a job, decided to start his own business. And combining his passion for snowboarding with an interest in e-commerce, Tobi, along with Scott Lake, founded an online snowboard shop. And pretty quickly, he realized that the existing e-commerce solutions were just completely inadequate. And so he developed his own platform using the open source network Ruby on Rails. And after one season of online sales, it became clear that the e-commerce software he'd built had much more potential than the actual snowboard brand itself. And obviously, he figured out that aiding others in building their own stores was a better business opportunity than just selling snowboards. And from there, his software ended up gradually transforming into what today is Shopify. And so Tobi has directed the firm through the initial adoption period and its extremely rapid growth since. Shopify's growth rates, even still, almost 20 years later, are just through the roof, which tells you how massive the total addressable market for them is. Over the last decade, we're talking about an average growth rate of more than 55% per year.
Wow.
And those are borderline ridiculous numbers. And impressively, the growth has been overwhelmingly organic, with maybe one or two small acquisitions in any given year. And one of the biggest factors I see behind this, which Tobi directly oversaw, was Shopify Payments, which has been a very strong growth driver since the IPO and is behind the organic and viral marketing approach they've used for merchant acquisition. Payments is a thorny issue for many small businesses, or at least it used to be, and Shopify has made the process so much easier for them. And just to hit on it again, because whenever we talk about software companies, especially something as boring as enterprise software, it can all feel a bit abstract if you've never used the services yourself, which I haven't. But in short, Shopify is a platform designed for anyone to sell anything, anywhere, giving entrepreneurs the resources that for many years were only really reserved for larger corporations. And since IPOing in 2015, Shopify has shown just how powerful its platform is by growing gross merchandise volume revenue by over 50x.
Wow. I mean, the numbers just look stunning. But as you said, if you've never used the product yourself, it can sometimes be hard to actually grasp what it does. So maybe just to make things a bit more tangible, could you walk us through how Shopify works in detail? And for anyone watching right now, they can see what the interface actually looks like.
Right. So Shopify centralizes a bunch of stuff into a single admin panel, giving a single view of everything from new orders to sales analytics. More powerful, though, is that it allows business owners to build and customize their own online store and then sell across various platforms, including not just online, but also mobile devices and even in person with physical locations and pop-up shops. The Shopify platform, though, is entirely cloud-based and hosted, ensuring secure access from really any compatible device with an internet connection. And that gives business owners the flexibility to manage their business from anywhere on the planet. So again, you can see exactly why Shopify has been so popular. Through Shopify, merchants get integrated payment processing, domain hosting, AI tools for brand content generation, mobile accessibility through the Shopify app, the chance to connect and partner with influencers through Shopify Collab, sales channel integration tools that make it possible to sell across Etsy, TikTok, and Instagram, and even point of sale solutions for in-person sales, as I already kind of mentioned. And it's almost to the point that whatever you could possibly imagine wanting to do to support your e-commerce business, Shopify already probably has a tool or platform in place to do it, especially through their marketplace.
I always wonder why anyone would still open a physical store in a time where we have companies like Shopify. I mean, don't get me wrong. I love those little physical stores. It's a totally different vibe, sitting in a cozy little bookstore around the corner, looking for new books to read instead of ordering them online in a Shopify store. But all the costs for rent, inventory that will probably never be sold, the bookkeeping, it's just so much more work and much more risky for the owners. Shopify lets you build a store in a matter of 1 or 2 hours, does all your payments, inventory management, shipping, sales, and bookkeeping. It's just so easy. And if the business isn't going well, you didn't pay much upfront anyway. Talking about payment, of course, Shopify doesn't deliver their services as a charity. While it still turns out to be a lot cheaper than if you would run a physical store, Shopify does take a share and perhaps some upfront fees as well. Do you mind walking us through what exactly Shopify's business is, how their model works, and how they actually make money, and what merchants need to pay?
From a business model perspective, there are a few ways, as you alluded to, that Shopify monetizes all the value it creates for users. Shopify reports its operating results through the lens of two segments: its subscription business and its merchants solutions business. The subscription business is what it sounds like. Companies can either have basic plans or more advanced plans, depending on their organization's size and needs, and those range in price from as low as $39 per month to $399 per month, and even $2,300 per month for Shopify Plus for the highest volume merchants. And you might think that this is their bread and butter, but subscriptions are really only about 25% of Shopify's sales. The much bigger business is with merchant solutions, and they monetize here by, for example, taking fees on every transaction that goes through Shopify Pay, or by making loans through Shopify Capital for businesses to finance their inventory. And then Shopify will again take a percentage of their sales as a fee until those loans are paid off. So as an example, Shopify might lend $10,000 to a merchant, and that merchant will repay $11,500 over time, and Shopify books at $1,500 as lending revenue. Or Shopify earns fees with things like Shopify Shipping, which is a shipping service they offer merchants. Shopify enables merchants to buy and print discounted labels directly from their dashboard, and this makes it easy for small merchants to fulfill orders without dealing with carrier contracts and external software or any of that kind of stuff. Basically, Shopify partners with major carriers like USPS, UPS, and DHL to negotiate bulk rates, and then merchants can access those lower rates and print labels from within Shopify, and Shopify keeps the spread between the carrier rate and what it charges the merchants for those shipping services. And then, as we've also alluded to, there is the Shopify App Store, where kind of like Apple, they take a fee on all App Store transactions. And those fees can be 20% or so for developers earning over $1 million a year. And more recently, they also unveiled Shopify Credit, which is a credit card from Shopify for Shopify merchants, where merchants can actually use the card for maybe running Google ads, which might be part of their marketing budget, and then earn 3% cash back on that spending. And all of those add-on services where Shopify can capture these sort of hidden spreads or behind the scenes fees make up the merchant solutions business. And that's why it actually ends up being a much bigger business, because it can scale with merchants' revenues over time.
There's so much I didn't know about Shopify. So for example, I didn't know they are also in the business of lending money. And on the one hand, that introduces some additional risks to their otherwise lean and straightforward business model. And then again, who, if not Shopify, knows who can pay back loans with a high likelihood? They know so much about the merchants. They know the sales history and the overall store performance better than anyone, except for maybe the merchant itself, and perhaps even better than they do. So they can probably get all the upside from a high margin business with a very limited downside because of all the data they have. Speaking about high margins, what's the take rate on these different business units?
Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. Want to land a job in investment banking or private equity, but feel like you're stuck on the outside looking in? That's where CFI, the Corporate Finance Institute, comes in. CFI is the #1 rated online finance and banking training provider, chosen by over 2 million professionals worldwide. CFI's courses equip you with the same skills top analysts and associates use at leading firms. I really appreciate that you can study at your own pace and have the chance to solve real-world problems with case studies. It gets even better though. Right now you can get 30% off any Corporate Finance Institute plan. Take the first step toward your dream job. Head to corporatefinanceinstitute.com, enroll today, and use code INVESTORS30 at checkout for 30% off. I just got back from traveling to Omaha for the Berkshire Hathaway shareholder meeting. I have to make sure I made my annual pilgrimage to see Warren Buffett. That's something I know many listeners of this show will appreciate, but while I was gone for a few days, I couldn't help but think about how my house back at home was totally unused, burning cash. Thankfully, that doesn't have to be the case anymore, since using your house as an Airbnb is now easier than ever. With a co-host, Airbnb enables you to have someone else do all the hosting for you. Not only do you get the joy of sharing your beautiful home with travelers, but you can also earn extra income to support your lifestyle and financial goals. My wife and I are currently saving up for our honeymoon trip, so anything that puts a couple of extra dollars in our bank accounts helps a ton right now. What I love about traveling is the lifelong memories I get out of it, and while I'm traveling and making memories for myself, I think it's just really cool to know that with a co-host, I can be helping someone else do the same thing. If you have a second home, travel often, or are away for extended periods of time, go find a co-host at airbnb.com/host and start earning extra money today. So the right way to think about Shopify's monetization is the take rate, as you smartly ask about. And that is the percent of revenue they earn from each dollar of gross merchandise value. If they facilitate $100 of e-commerce sales for a merchant and earn $1 in fees, that would be a 1% take rate for Shopify. With their subscription business, Shopify's take rate is much smaller at about 0.8%. And that's very steady and probably not going to grow much. If anything, as they work with more enterprise clients with larger gross merchandise volumes, the take rate on those subscriptions will probably decline. But with the merchant solutions business, as they found more and more services to offer merchants, with different ways to monetize those services. The take rate is higher at over 2% and has been steadily rising over the last few years. Shopify Credit is one of those examples we've talked about, and I already named some others. That monetization isn't as straightforward as just charging a fixed subscription, but it is really in their ability to earn spreads on shipping or lending, which are these more hidden costs. And it's probably why they can generate higher take rates with the merchant solutions business, because it's not as obvious the price that is being paid, or at least it's maybe more clear the value that is being received for a given service. And obviously the combined take rate is closer to 3%, which is pretty good. It's a completely different business, but you could contrast that with our other portfolio company, Airbnb, which earns a take rate in the 12 to 15% range. But that also comes on a gross booking value. It's about a third of Shopify's gross merchandise value. So they're different but similar models where they're both playing the take rate game, but Shopify takes a smaller fee of a much bigger number. And honestly, that probably is more sustainable than the high fees that Airbnb captures. And of course, we still like Airbnb, or at least I do. The beauty, though, of Shopify's flywheel is that they have a low friction onboarding process that brings in tons of small merchants. As merchants grow, Shopify monetizes those merchants more via merchant solutions. And then some merchants will upgrade to Shopify Plus, driving even higher margin subscription revenue. So in summary, the more gross merchandise value that flows through Shopify, the more it earns from payments and capital and shipping and other value adds on top of subscription fees. And now you can kind of see why I think Shopify is an incredible business.
It is a very compelling flywheel. And time again, we see how these mechanisms create the tech giants that keep driving stock market returns for the US, but also global indices. We're discussing quite a lot of these companies here on the show. You're probably an even bigger fan of them than I am, although I like them as well. And still, we both would probably call ourselves value investors, largely influenced by Buffett. Now, he's famous for passing on all these tech companies since he is convinced he couldn't determine their moat. In fact, for a long time, he thought these companies just have a much harder time even building a moat due to the rapid pace of innovation in all these high-tech spaces. And even if they have a moat, in a high innovation industry, the half-life of that moat might just be a lot shorter than for all the other companies that he usually likes to own. By now, he does own some companies that I would consider tech companies. I'm not sure if he would say that as well. For example, Visa or MasterCard. But still, a company like Shopify would probably never make it into his portfolio, at least if it's not Greg, Buffett's second man, who picks it. What's your view on the modes of companies like Shopify and still being a value investor? Does it matter to you in any particular way?
It's an interesting point to mention how quickly moats can change. Though in some cases with Adobe and Microsoft, we've seen these moats last for decades for software companies. And it's a dilemma that I think has really fragmented an entire generation of value investors. There are folks out there who have completely avoided companies like Meta, Microsoft, and Alphabet simply because they believe they can't understand them, yet they have been the biggest drivers of the major stock indexes for 15 years. So that has been a costly omission. And there's this feeling that to invest in tech companies is almost to reject Buffett's success and presume yourself to be perhaps more capable of assessing business quality and moats than the Oracle of Omaha. I don't see it that way, but I think some people do. I've met those people, and they try to focus on truly very simple businesses in the most literal sense, which is a great thing to do. And if we had really literally followed that thinking, though, we also certainly wouldn't own Airbnb, Alphabet, Reddit, or Uber. So maybe we're biased because we've already committed the original sin of going into the tech world, you might say. But what I really would want to argue is that there are always shades of gray. And for starters, I try to learn from Buffett as much as possible. But we shouldn't treat him as an infallible figure to blindly follow. I also learned from many other great investors, and maybe I'm naive, but I do buy into the belief that the best businesses of the 21st century are software companies. And I don't even know that Buffett would disagree with that. I'm not trying to play the exact same game that Warren Buffett has played throughout his career because, well, in part, we live in a different world. And I also can't invest the way Warren Buffett has because I'm not Warren. We all have to do what personally makes sense for ourselves. And what I do know is that Shopify will continue to be one of the primary winners of further e-commerce adoption in the coming years around the world. And that is compelling to me, or at least it catches my attention and makes me want to dive in further as we're doing today. And between the platform's ease of use, the large community of support experts, and this emerging developer ecosystem in the App Store, the company has a number of advantages that I believe are combining together to form a very wide moat. And it's not a huge surprise that Morningstar has kind of validated that belief by also issuing a wide moat rating for Shopify.
If Morningstar has your back, that's always a good sign. To me, the real story isn't whether Buffett missed tech. It's more so how the nature of moats has evolved. A lot of today's dominant tech companies like Amazon, Google, but also Adobe and perhaps also Shopify didn't look like they had durable moats or durable competitive advantages early on. They weren't capital intensive to start, and this sort of vague term of innovation was always hanging over their head. But over time, with scale, data, and most importantly, network effects, they've built economic fortresses that can last for decades and who knows for how long exactly. That's what makes tech so tricky. Without these scale advantages and the user lock-in, these businesses are vulnerable. But when those elements click into place, you suddenly have companies with moats that I would say rival or even surpass what we used to see in industrials or consumer goods that Buffett liked to look at. But enough with all the problems and the difficulties of tech. How about you give us the bull case for Shopify? That's why we are here.
The bull market is basically just that Shopify will continue to grow dramatically with its gross merchandise value booming as it onboards more businesses onto its platform. And with add-on features, the company will also increase its take rate over time by upselling merchants on more and more additional features. So more commerce is going to be going through Shopify, and Shopify is finding clever ways to capture higher fees on that commerce in percentage terms. And so Shopify is just really attractive to small and medium-sized businesses for the simplicity of it. Yet at the same time, Shopify has proven that it can move upstream and appeal to larger enterprises too. And if that continues to be the case, that is very promising for the company because big enterprises are where the really juicy margins are.
That's true. And also pretty straightforward. How about you give us the bear case then?
Okay, yes. The bears would argue, and this is maybe more important to focus on, and they would argue rightfully so, that Shopify trades at some very lofty valuations. And even if the company does grow significantly, it may not be able to grow fast enough to justify current share prices. It's also very highly exposed to the economic cycle, such that a recession that causes a number of small businesses to go under could be very damaging to its top and bottom lines. And obviously, recession concerns are very popular right now as the market has moved dramatically from a greed cycle toward fear, or at least it has at the time of recording. For Shopify, in a recession, there'd be a two-pronged effect, where not only would retail sales drop off, that Shopify takes a small commission on with its take rate for merchant solutions, but also, as I just mentioned, companies might fail altogether and cancel their subscriptions, which would bite into that quarter of Shopify's revenue from subscriptions.
This does sound like the potential setup of what could become a pretty significant hit. Not only would the fundamentals decline, but you also must factor in a pretty big multiple contraction. Just to give a perspective on how severe that impact could or might be, taking Shopify's current EV to EBIT of 110, where EV is the market cap plus debt minus cash, then when the market gets spooked by recession fears or something similar, perhaps tariffs, they might reduce the growth expectations for Shopify and only want to pay a multiple of 55, which would still be double of most magnificent 7 companies. So even if Shopify's EBIT would be unchanged, its stock price would be cut in half. Now add to that an actual recession in which many small shops go out of business, and then you have declining profits and declining multiples, which is something like the perfect storm. This is the big problem of investing at high multiples. As long as the company grows, everything is fine, but one hiccup and it becomes so costly that it could take years to recover from that.
You're doing a very good job of making the bear case for me, Daniel. There's no doubt about everything you just said being true. And I fully agree. Fast growing companies that trade at high multiples of sales and earnings are the most likely to get hit the hardest by Mr. Market's panic during a recession or even just a correction in the stock market. So it could get dramatically repriced from current levels. And I would say at the current valuation, it was probably more likely that that multiple goes down than up. And clearly, this is also not a healthcare company where you would expect them to be maybe entirely immune to a recession, since people are always going to need medical services. When you have sales decline for a company with as much operating leverage as Shopify, and as a company that is as closely tied to the global economy as Shopify is, that ripples down to have a reverse economies of scale effect that delevers their business and could pretty swiftly wipe out their operating profits entirely in a worst case scenario. Very much a worst case scenario. I don't think a recession would bring Shopify to its knees. But just from an investor's perspective, if you're looking at the company on a 5-year horizon and 2 of those years end up being a recession, then the company might spend the next 3 years bouncing back from those setbacks, leaving you with no real return, no compounding in the meantime. You've treaded water for 5 years, and the opportunity costs of that are very steep.
I don't want to be too bearish, and we are long-term investors. So let's take a look at the more positive side of what Shopify could achieve long term. We also want companies that might not yet be cheap, but we could load up the truck when a scenario like a recession actually happens. And as you mentioned, I wouldn't suspect Shopify to go to its knees even if a recession would actually appear. Now, to add Shopify to my shopping list in case there is a recession, I would need to better understand the stickiness of Shopify's products and how that forms, let's call it again, a moat around Shopify that they could use to bounce back when the economy would pick up again in a worst case scenario and continue to earn these excess returns on capital relative to their opportunity costs, which they have done in recent years, or at least in 2024, where they have generated attractive mid-teen returns on invested capital. So how does it look for Shopify and their competitive advantages?
Switching costs are for sure one of the biggest factors in Shopify's moat. Just intuitively, if you are running your entire business through a single platform, you're probably going to find it very difficult to switch away from it. There's a lot of built-in inertia there. And there's the risk that data gets lost along the way too, which adds to the time cost of switching and the pressure of executing a switch well. And all of that combines together to discourage switching unless absolutely necessary. In some cases, it can take companies a full year to migrate away from Shopify to a competitor, which is something we talked about with our portfolio company, Adobe. And at worst, it would be a slow exodus over time that the company would be trying to aggressively counter, assuming that some competitor came on with a product that was maybe an order of magnitude better. I'd also add that a sort of secondary moat for Shopify are the network effects around its business. And a network effect, as most people probably know, means that a system becomes more valuable as more people use it. So Facebook is obviously a network effect. And in Shopify's case, their network effect comes from their app store that I've mentioned a few times. And they have more than 10,000 available apps there. And that is a big enough scale that, at least in my opinion, I think they should be able to continue attracting more developers who will make the company's software better, which then in turn attracts more merchants to use Shopify. And the apps really level up merchants' Shopify stores. And some of them are pretty cool. They can be as simple as just adding a countdown clock to a checkout page, which increases the pressure to make a purchase, to apps that will use AI to create and recommend product bundles based on what people have previously purchased or shown interest in. There's also a network effect around Shopify's referral program too. Tens of thousands of Shopify users have referred at least one other person to the platform. In exchange, Shopify pays a fee to anyone who makes a referral. It might be an expensive way to acquire customers, but it actually ends up working really well for them because the new referral customers tend to, on average, be higher quality users who stick with Shopify for longer and then generate higher gross merchandise volumes. Or at least that is what management has told us on earnings calls about the referral program.
That's surprising. I think most referral programs are attracting lower quality members instead of higher quality ones. I've also seen some of the features of the apps that Shopify offers, and I think we've all seen that countdown way too many times in our online shopping experiences. And of course, isolated, those are pretty easy to copy and they are nothing special. But if you combine them, all these apps with the range of Shopify's services and the sheer scale of the merchant network, that creates a difficult to copy ecosystem, all in all. I've also heard Shopify venturing into the logistics business a couple of years ago. This has been a major differentiator for Amazon and their whole trajectory. And they spent billions of dollars to build out their fulfillment centers because Bezos knew convenience matters most. And fast delivery is the ultimate convenience if it comes to e-commerce. And it's not just Amazon. Alibaba chose a different path than Amazon, but also ended up running its own logistic company. And the same goes for Mercado Libre in Latin America and Coupang in South Korea that you've covered as well. I haven't heard so much on that end from Shopify ever since. I think it has been 3 or 4 years ago. So how is that project going? Do they have this huge logistic empire or what happened to it?
As you can imagine, the logistics end of things has been a big part of the story here. And at one point, Shopify's aim was to have its warehouse management software be able to provide package delivery in 2 days or less for more than 90% of the US population. And to do that, they began to build out a network leveraging third-party partners with warehouses and sorting centers, freight handling, and also last mile delivery. And what I'm describing here is the backbone of the so-called Shopify fulfillment network, which was originally launched in 2019. The idea was for merchants to manage their fulfillment seamlessly through Shopify, whether that be with real-time inventory tracking or the handling of orders and returns. And as part of this fulfillment focus, Shopify acquired a company called Deliver, spelled with 2 R's, for $2.1 billion a few years ago. But then in 2023, Shopify made a very dramatic pivot away from logistics and sold all of its logistics assets, including Deliver, to a company called Flexport. So that was a huge switch, where they not only undid a major acquisition, but basically concluded altogether that order fulfillment was too messy and was distracting from their core mission of developing an e-commerce software ecosystem. And I mean, literally, Shopify CEO called the logistics venture a side quest, which is a video game reference. And I think just trying to integrate Deliver got way too complicated too quickly for them.
That explains why I've never heard of that venture again. And on the one hand, it's understandable because logistics is nothing you can do on the side. It's not a side quest, as you will probably know by now as well. And all the big e-commerce companies who succeeded in logistics made it a priority. And they were ready to invest huge sums of money into what is a capital-intensive business with very slim margins. You have to build warehouses, you hire huge delivery networks, you have to manage a fleet of trucks, deal with labor challenges, and just constantly invest in new technology to stay efficient and be on top of your game. And it only makes sense if you have an ecosystem in place that just benefits in its entirety from these investments. But honestly, I would have thought Shopify has that ecosystem in place. I mean, you elaborated on it quite a while today. They might have realized that this would have positioned them as a real competitor to Amazon. And that might have become just a very costly endeavor with a low probability of sustainable success.
If you're looking for a red flag, or maybe just a reason to be a little less optimistic than the market is on Shopify, it is definitely fair to argue that this was a major blunder. Now, to their credit, they did backpedal as opposed to digging themselves into an even deeper hole, which some companies have done in similar circumstances, but still, it's not a great look, and I don't want to make excuses for them. The Shopify fulfillment network is still a thing, and it is a valuable offer to merchants, but it is all managed by Flexport now. Shopify kind of copped out, and they burned a few $1 billion along the way by buying Deliver and then basically giving it to Flexport in exchange for what is now, in hindsight, a very small stake in Flexport and probably some operating agreements that tied them together for a few years. But around that time, they made this big switch from logistics. They also cut 20% of their workforce and replaced most of their C-suite. So it was a time of big change at Shopify. And Business Insider actually called it a midlife crisis, which is kind of funny, but I definitely don't think Shopify is halfway through its life. As Shopify's business boomed during the pandemic, though, I think it is safe to say they just got way too far ahead of themselves, which was a very common thing in 2021. I think we can all remember that this was a time of excess optimism, to put it mildly, across really the entire financial system and corporate world, at least across the US. But just on that midlife crisis point, the company really has changed a lot, as you can imagine, when you have such rapid growth. For starters, Shopify used to literally have a go-kart track in its office space in Ottawa. And now you hear stories about the company and how it's been tied down by layers of middle management and bureaucracy, which were at least in part behind why they did some of these sweeping layoffs a few years ago.
Seems like a natural and perhaps also a healthy development for a company like Shopify to not have a go-kart track in your office anymore. And although Shopify avoided competing with Amazon directly in logistics, there are obviously more similarities between these two companies or businesses than just that one part. A major one, which is also a big part of Shopify's bull thesis, is this idea of shared economies of scale. If I'm not mistaken, the term was popularized by Nick Sleep in the value investing space, and he used it to describe Amazon as one of the companies, and then also Costco. The idea is that when a company gets bigger and more efficient, it doesn't keep all the benefits of that size and efficiency just to itself in the form of margins and profits. Instead, it passes some of these savings back to its customers. Amazon achieves this by leveraging its scale and ecosystem to reduce costs for services such as shipping, warehousing, and cloud computing by mostly spreading those fixed costs across an increasing number of sales. But instead of just keeping all the cost savings for themselves, they then choose to pass a lot of it, not everything, but a lot of it back to customers in the form of mostly lower prices, but also faster shipping and better selection. And Shopify does something similar, just from the merchant angle. As Shopify grows and signs up more merchants, it can negotiate better rates with partners or invest more in improving the platform. And instead of hoarding all those benefits, they pass a lot of it back to the merchants. Cheaper payment processing, better shipping options, and just a more powerful app, which makes it even more attractive to join Shopify as a merchant.
It's hard not to say that there isn't some kind of competitive relationship between Shopify and Amazon, even if they have also found ways to work together. After all, Amazon accounts for roughly 37% of all e-commerce sales in the US. And those are just transactions that are occurring on their marketplace. Meanwhile, if you look at the transaction volume that goes through Shopify's merchants, their market share is something like 10 to 12% of US e-commerce. So it is a distant second to Amazon. In 2022, Amazon expanded its ambitions beyond its own marketplace by announcing that it would extend some of its Prime membership offerings to merchants off of its platform by embedding their payment and fulfillment options onto third-party sites, which is what they call their Buy with Prime initiative, meaning merchants can store and ship products using Amazon regardless of whether they're selling on Amazon's website. And that was a signpost moment where it became clear that Amazon actually wants to be the default fulfillment network for all of e-commerce, not just orders on their own marketplace. So on a company's website, they can show the Prime logo and offer Amazon's 1 and 2 day delivery options with checkout through Amazon Pay. And when you think about it, that is all a pretty incredible offering to merchants.
Traditionally, Shopify has been all about giving power back to the individual merchant, helping them build their own brand, control their own store, and also the customer relationships. Amazon has been much more centralized. Sellers plug into Amazon's ecosystem, but it's Amazon's brand and customer base that really dominate the experiences. But lately, it feels like Amazon is trying to tweak that playbook a little, and you just mentioned it. They're starting to offer merchants more tools to build their own presence inside the Amazon ecosystem, So the lines between those two models is kind of blurry by now, and it raises a pretty interesting but also significant question about where Shopify fits into that shift in the next 5 to 10 years.
They have had opposite models in a way to compete for merchants' attentions, even if they're both sort of ultimately going after the same end customers. And with this Buy with Prime initiative, that has been a big shift away from Amazon's centralized marketplace focus to something very different, potentially integrating Amazon into any kind of e-commerce and making it more of a platform company for enabling e-commerce like Shopify. And from a different perspective, a fulfillment first perspective, but still. And I'm sure you can imagine that this brushes up with Shopify and with logistics. They were very directly competing with Amazon. And as we know, Shopify sort of retreated from that area. Yet at the same time, Shopify's CEO responded to this Buy with Prime initiative by saying that they were thrilled by the news. Take that with a grain of salt. But he did suggest that they would integrate these features into Shopify, just as they've integrated features from companies like Meta, Google, and TikTok. And obviously they tried to play down how disruptive this could be for them. So it is true that Shopify integrates with many other platform companies, and Shopify has been true to its word and made it possible for Shopify merchants to easily embed Amazon's Buy with Prime button onto their storefronts. And I think that really did mark a significant change in the competitive relationship between Amazon and Shopify. A Shopify merchant might want the independence and branding of their own site and the additional reach of Amazon's marketplace. And Shopify knows that. So on the one hand, Shopify offers a streamlined interface where you can easily take advantage of things like Buy with Prime. And yet on the other hand, Buy with Prime was arguably a warning shot from Amazon that they wanted a bigger piece of the e-commerce pie. And Shopify could either roll over and share more of the pie with them or engage in what would be a very difficult battle for them to win. And at one point, Shopify did try to play the game of competing with Amazon by blocking Buy with Prime. But again, they ultimately relented because, in my opinion at least, Amazon is just such a giant force that you do not want to go against. Under this sort of peace treaty that Shopify and Amazon came to in 2023, the result is that a Shopify merchant can add a Buy with Prime button on their product page. And if a customer uses it, the checkout and fulfillment are handled by Amazon, while Shopify still records the order and data on the back end. So Shopify's condition for a truce was that merchants would still control 100% of their customer and transaction data, even when Amazon is the one handling fulfillment. And I don't know if Amazon will eventually trample Shopify, but Amazon has certainly shaped what directions Shopify can go in and what it avoids doing.
Looking at the history of Amazon and its relentless path of innovation and expansion, it would surprise me if they wouldn't try gaining more market share eventually. And the fact that Shopify tried initially blocking Buy with Prime and then had to accept it isn't reassuring for Shopify shareholders either. It's another reason for Shopify to double down on their unique value proposition for merchants. And I don't know if you feel the same way, but we've seen logistics and now this Buy with Prime initiative, and it always feels like Shopify is only getting the second place when it comes to competing with Amazon. What would you say are the biggest differences between merchants who mostly use Amazon and those who rely on Shopify? Because that's probably where Shopify's advantage lies in, and we could better assess whether that's sustainable or not.
So Shopify appeals to merchants who have their own distribution and want to control their branding by directing customers to their own website. As Shopify CEO has described it, Amazon is trying to build an empire and we are trying to arm the rebels. So there's that Star Wars reference again from the beginning of our episode today, for any listeners who are wondering about the origins of that. And maybe a merchant ranks highly in Google search, for example, and they have a large social media following, or maybe they're well known in a local area. They do a lot of paid marketing or just have a lot of organic web traffic for some reason. Whatever it is, Shopify supports those merchants who are trying to sell on their own. They have their own customer flow, their own traffic. Whereas Amazon, of course, appeals to merchants who are trying to specifically rank for searches of certain items on Amazon's marketplace, which obviously comes with massive traffic, a massive number of visitors. And to a lesser extent, but still importantly, sellers on Amazon are also looking to take advantage of Amazon's fulfillment network and logistics, which we already know Shopify struggles with. And on top of that, Amazon also handles the customer service side of order management for merchants. So it's just simpler to sell through Amazon in many ways. But that comes at a higher cost in terms of both fees to Amazon and the loss of control over their customer experience and their branding, which is sort of more of a hidden trade-off, I would say.
But I'm sure there are also many sellers who use both, like Shopify and Amazon, right?
Totally. And despite these different visions of the future of e-commerce between Shopify and Amazon, and us framing it as this e-commerce war and the battle for it, there is definitely a good bit of overlap between merchants who take advantage of both platforms. It is obviously not an either or, and even less so after the rollout of the Buy with Prime button. So the way I would put it is that a company could be both an Amazon merchant and a Shopify merchant. But the reality is that a good chunk of merchants on Amazon really only sell on Amazon. And I don't know exactly why that is. It probably has something to do with the fact that these are just smaller brands, and it's just easier for them to focus on one outlet for distribution, especially one like Amazon, where they're offering to handle so much of it for you. And we've talked about the lines kind of blurring here between the advantages that Amazon can offer and the advantages that Shopify can offer. And I would say the lines have blurred even further because Shopify now has its Shop app, which used to just be for order tracking, but now it has a marketplace shopping functionality too, where basically they have a platform where customers can scroll through and see what Shopify merchants are selling. It's essentially a really lightweight version of Amazon's main app. And I like the idea. I'm not super optimistic on it, but if they can get enough adoption for it to work as an alternative to Amazon's app, maybe that's promising. Honestly, I didn't even know customers could shop directly through Shopify in this way before I started researching the company. And it's actually funny, I have the Shop app on my phone, and I just never used it. So I didn't really I had the opportunity to know this, and I just never used it. So if that's telling at all about the awareness around this product and the likelihood of success for it, then that is maybe concerning.
I mean, I don't have the app, but I've heard of Shopify's Shop app some years ago. From what I know, Shopify didn't really nail the marketing since many users didn't know what Shop is actually for. And probably you're one of those users, although you've downloaded the app. And without wanting to sound too negative, I feel like that's kind of my theme here. Although Shopify is a fantastic business model, I just don't see them winning a war with Amazon, no matter on what front they play it. And if you stack them side by side, Amazon's big advantages are pretty clear. They have built this huge fulfillment network. They have this marketplace with over 300 million active users to market and sell to. And it's a massive engine for driving sales. Shopify, on the other hand, gives brands something that Amazon can't and doesn't want, actually, which is full control. And I would imagine that strong brands, especially the smaller local ones that you've also mentioned, would prefer Shopify and continue to do so, as growing your own brand on Amazon is just pretty difficult to do. But you've said that most brands on Shopify sell on Amazon as well, and that's kind of refuting my thesis. So I suppose only truly strong brands strive to establish this direct-to-consumer presence rather than selling on platforms like Amazon. The more replaceable a product is, the more likely you are to just go to Amazon, sell it, leveraging the ecosystem, and instead of running your own shop and having all those doubts and headaches that you have running your own shop. A key part of that is Amazon's advertisement business that is not often talked about, but it's the third biggest after Google and Meta, and it's a huge pull for merchants since it lets you acquire customers within Amazon's ecosystem.
Another way you could say all this, I think, at least in Shopify's favor, is that they appeal to brands who truly want to, quote unquote, own their customer as opposed to renting customers through Amazon. And if you were going to argue that Shopify could win the war, the argument would really boil down to that. A large number of e-commerce brands want to own their customer. Amazon is excellent, though, for customer acquisition, but not necessarily loyalty to the merchant, since the customers there are ultimately Amazon customers. Shopify enables more brand loyalty, but it does require merchants to have some skill in customer acquisition from different sources, which is why I say Shopify makes a lot of sense for brands that already have web traffic coming to them. And although you might not own the traffic coming to you on Amazon, because ultimately Amazon's algorithm is determining which brands get highlighted, as I've said, you can tap into their logistics network, which means independent sellers can ship products to Amazon warehouses and enable them to be listed on Amazon as either 1 or 2 day delivery. And doing that is just going to dramatically boost sales. That is quite literally hard to compete with, as Shopify has found out the hard way. So I think that tells you about the different types of businesses the two platforms might attract. A city's most popular bakery might have a Shopify store for online orders. And because they're a localized business, they're not selling at all on Amazon. You're not selling cookies on Amazon. And as such, they don't necessarily need a fulfillment network because their business is geographically segmented to one area and is probably mostly in person. Meanwhile, a brand that's trying to sell something commoditized like low-end bike helmets, just to use that as an example, and maybe they're trying to do so globally and they're sourcing from China, it's going to make a lot of sense for them to use Amazon because they don't really care about brand differentiation. And they just want to maybe take advantage of the best logistics available to them and get the most face time in front of the widest range of potential customers. And then in the middle, kind of straddling these two worlds, you might have some trendy, let's say, organic deodorant company. That sounds like something you'd see an ad for on Instagram. And they have their own website through Shopify, and they funnel people to it from either TikTok or Instagram. And perhaps they also rank well on Amazon, and they kind of leverage both. And they might get 30% of their sales from there too. So they use Amazon, but they're also not completely reliant on it. Like I said, they have social media traffic that's coming directly to their website too. And that maybe that's most of their business. And that's kind of what you might imagine when you think of a company that is using both Shopify and Amazon. And it's a stereotypical way to imagine the differences in what these merchants look like. But the point being there that there is some overlap, but also some discrepancies in the types of businesses that are maybe entirely Amazon focused, partially Amazon focused, or who just avoid Amazon altogether and don't get anything from it. And given all the fees that Amazon takes, it's almost certainly more profitable to have a sale come through a company's Shopify store than it is to go through Amazon. So there is an incentive that if you can get enough traffic to your website to try and sell there. But again, some brands are happy to make that exchange because they can tap into much larger potential sales volume on Amazon, even if that comes at a higher cost.
We've now talked a lot about Amazon and Shopify and how they fit into the picture. But when I think about Amazon's biggest competitor, at least in the US, I think Walmart comes to my mind first. And so how do they factor into this picture? Are they having a connection to Shopify as well? What's the relationship there?
It's funny because Walmart actually teamed up with Shopify to bring a curated set of, I believe, 1,200 Shopify merchants onto the Walmart marketplace back in 2020. And I guess this was sort of a mutually beneficial alliance. It gave Walmart's online marketplace a boost in assortment, helping it compete against Amazon, and offered Shopify merchants a new sales channel too. And you might also say that it signaled that large retailers see Shopify's merchant base as an asset to tap into, and perhaps that the old adage, the enemy of my enemy is my friend, perhaps explains why Walmart and Shopify wanted to align together to take on Amazon. And how long that alliance can last is maybe another question, but to this day, Shopify merchants can still be integrated into Walmart's marketplace. And Shopify has made similar kinds of partnerships with Facebook and Google too, making it easy for merchants to promote their products in those places and make sales through Shopify. So it does kind of feel like these big tech companies are working together to take a bite out of the biggest of the big tech companies in the e-commerce world, which is Amazon.
I mean, it kind of makes sense. Amazon is just so big and sort of a threat to all of them. Why not team up and not fight this war alone? But besides selling their logistics business, which has been because of Amazon, and responding to the competitive threats that come from them all the time during the pandemic era especially, I believe Shopify also did a share split back then, right?
In 2022, Shopify did announce a 10-for-1 stock split, yes. And a stock split is an arbitrary thing that some people get excited about because it increases the number of shares you own, but it is not a dividend where you're actually getting paid something of value. Literally, if you owned 1 share of Shopify, you were now given 10. So you didn't actually get wealthier, you just got more shares while the stock price was proportionately repriced because everybody got more shares at the same time. So it just became an order of magnitude cheaper. As I said, it's a completely arbitrary thing, but it does basically make the stock more affordable, maybe to retail investors to purchase, which in the margins maybe creates more liquidity and draws more retail investors to buy shares in the company. These are not reasons why we invest in businesses, Daniel, but this is how some people think of it. And still, economically speaking, nothing has changed. But that is also not all that Shopify did. At that same time, Shopify also created a new non-transferable share class called the founder share that would be granted to Tobi Lütke, and together with his existing ownership share would give him 40% voting power over the company. So this is just really concentrated power in the CEO's hands, and we see this with a lot of these Silicon Valley companies, even though Shopify, I guess, is actually not a Silicon Valley. I'm not sure what the Canadian equivalent is, but you get the idea. And again, like I said, he is really concentrating power such that any shareholder vote that goes through is going to have to go through him. He can almost single-handedly sway the outcome of any vote. And that creates a conflict of interest for shareholders. Fortunately, this voting power is voided if Lütke no longer serves as the company's CEO, director, or consultant. So not transferred to the next CEO per se, but again, this just confirms that any bet on Shopify is really a bet on Tobi Lütke. Sometimes having a founder concentrate power is great if they're brilliant and thoughtful, but it can also be a nightmare if they can't be deterred from making what ends up being a huge mistake. Mark Zuckerberg's metaverse comes to mind. There are a lot of things that can go wrong with this kind of concentrated power and not having an independent board. But just one example is that the board is supposed to negotiate CEO compensation on behalf of shareholders. The CEO isn't abusing shareholders to enrich themselves. And if the board isn't independent because they're all selected by the CEO who has all the voting power, well, you can see the conflict of interest. So it is no coincidence that on top of already owning 6% of Shopify, Tobi Lütke managed to secure a 9-figure compensation package for himself last year, too.
I must say, this doesn't look too good. I don't know enough about Lütke personally to have a strong opinion on whether I like him having that much voting power or not. On the one hand, no one understands a company better than its founder, especially a company as mission-driven as Shopify is. But on the other hand, there are a lot of examples where founders were amazing at building something from nothing, but maybe not the best people for scaling it from a $100 billion company to a $1 trillion one. When you've got a dual share class structure with concentrated executive power and a board that isn't fully independent anymore, it can create blind spots, even for the greatest founders. You mentioned Mark Zuckerberg, who is without any doubt one of the greatest founders on Wall Street, and even he makes mistakes that are costly and cost billions and perhaps even tens of billions. If things start going sideways, there aren't many natural checks and balances to course correct. It's not a huge problem when everything is going well, but if strategy or execution starts slipping, it can get messy really fast. In the end, it can go both ways, and it's one of those situations where only hindsight will tell us whether this was a good move for the company or not. Perhaps it's best if we just avoid the guessing game and come to the fundamentals of the company. So how about you walk us through your valuation process for Shopify?
There's no doubt that this is a terrific business. For all the bear cases and concerns we've raised, objectively, this is a terrific business. And having the work done on the best businesses can really pay off handsomely, as you know, if we get the chance in a bear market to initiate a position. Already having that work done is just a big advantage. And that is kind of what I hope to accomplish with Shopify, because I already knew upfront it was richly valued. So I didn't think that we were going to be adding it today. But with that said, for my model, I focus firstly on estimating the amount of gross merchandise value that I think can occur through Shopify's merchants based on historical growth rates and some of the initiatives I know they're working on. And then from there, I try to estimate the take rate for Shopify as a percentage of all those merchandise sales, which I do think can continue to grow a bit modestly over time as Shopify continues to scale its merchants solutions offerings and add more features that can be monetized beyond simply just the subscription fees that users pay. So with that, I am able to estimate a revenue CAGR of about 20% by 2029, which is fast growth, but it doesn't take one too long after first studying Shopify to see how massive their market opportunity is and how much of it remains untapped. And through that lens, and based on their track record, 20% a year is honestly conservative relative to even what many analysts on Wall Street think the company can do. And from there, with that said, I tried to make some estimates about what operating margins could look like for them. And I've got margins expanding by a few percentage points as I continue to realize the benefit of economies of scale as a software company. And then with all that, and there's a lot of digging through financial statements and dirty work like that I won't drag you through right now, I get a model of the company's operating profits mapped out over the next 5 years.
And with that model of operating profits, which we normally treat as a sort of ballpark way to put some numbers around all of the qualitative considerations we discussed today and in this episode, I'm guessing you try to narrow in on an exit multiple. Can you maybe just walk us through how you think about that, where Shopify should be valued in 2029?
You beat me to the punchline, but as you said, the next step is to sort of trying to account for a realistic exit multiple that I think the company could be sold for in a few years, right? If you're going to, whenever you're buying into a company, you need to think about your exit strategy. So what will the valuation look like down the road? And as they continue to grow, I do think the exit multiple should probably be relatively higher than the market average, even still by 2029. But we also are going to want to account for it to decrease a bit as the company continues to mature. And if we look at the NASDAQ 100 index of big tech companies, that index has grown its earnings per share at about 11% per year over the last 5 years. And the enterprise value to operating earnings ratio for the broader large cap tech sector is about 25 times. So you're paying 25 times operating earnings for a share of the company. And when we think about Shopify growing its operating profits per share by well more than twice that in the coming years, it's no surprise that Shopify looks expensive at around 50 times operating earnings. And we also know that the company will likely still command a premium valuation over its peers by 2029, even if it does come down a bit, because we know that Shopify is probably still going to be growing faster than the market averages, and the markets like to pay up for growth. So in my model, I have them trading at around 30 times operating earnings as sort of the average point in a range of what I think are maybe plausible exit multiples. And like I said, 30 times operating earnings for a company that might still be growing 1.5 times as fast as the NASDAQ 100 is not that crazy. So there's room to be more aggressive, but with all these assumptions, I get an intrinsic value per share of about $53, which I calculate as the price we'd need to hit for me to feel very confident about being able to earn a double-digit annual return on average going forward without relying on exorbitantly high valuation multiples, which are just never guaranteed. I do see Shopify as being very richly priced, given that the stock is currently trading about $40, call it $45 per share, higher than my buy price target. Where in my defense, I'm still forecasting 20% plus annual revenue growth and an exit multiple of 30 times operating earnings, which I don't think anybody could accuse me of being conservative. And that would still leave Shopify actually trading at a premium to Amazon's current valuation of 29 times operating earnings. And I know I'm throwing a lot of numbers around, which can be hard to follow. If you're watching this, you'll be able to see some of the numbers I've been talking about in screenshots from my valuation model. But for those interested in the modeling stuff, that is a quick rundown of how I'm thinking about things, with the point being that Shopify is a really great company. And it's no surprise that the market recognizes this, if not maybe a bit too much. And for anyone who wants to download my model on Shopify, and just for context, we talk about our models every week on the show. And if you wanted to actually see it, you need to go to our newsletter. So we have a newsletter linked to in the show notes below in the description for this episode. If you just click it and then you read through the Shopify newsletter for this week, at the bottom, you should find a link to the valuation model.
I like that you resisted the temptation to just plug in numbers that would justify Shopify's current price. It's not easy to resist. You have a great company that's already proven it can grow at rates beyond 20%, but it's no small company anymore. It's a lot harder to go from 100 billion to 500 billion than it is to go from a billion to 5 billion. And just for perspective, at your assumed 20% annual growth rate, Shopify would keep doubling its revenues roughly every 3.5 years. That's incredibly fast growth already. So the fact that even this growth rate would suggest Shopify is trading at almost double its fair value says a lot about the market's expectations for Shopify. And this ties into a bigger point about paying up for growth. Investors are willing to do it because true compounders, businesses that can sustain high returns over a long period, are kind of the dream of every investor. Compounding without any turnover, the difficulty of finding new great opportunities each year, which is just not easy to do. But the key is figuring out what growth is already baked into the current price and what's realistic going forward. If you look at frameworks like the Graham and Dodd PE matrix, it basically shows that the higher the expected growth, the more you can justify paying a higher multiple. But only up to a certain point. At some level, no matter how great the company is, and Shopify is a great company, the opportunity costs get too high compared to safer alternatives. So it's not just about whether Shopify can grow, it's about whether the growth you are paying for today actually leaves enough margin of error. But you understand the company much better than I do, so I'm curious to first hear your take on the valuation and adding it to our intrinsic value portfolio, and then I will have some closing thoughts.
Yeah, it's funny because I'm the one pitching Shopify, but I want to emphasize I'm pitching Shopify generally and not at today's current prices, which I think we both see as not being all that attractive. It's a company I know I want to buy at a better price though. And I get the whole argument that if a business is great and grows fast enough over a long time period, it really won't matter if you overpaid a bit. But in this case, I can't even in good conscience put numbers into my model that spit out the current share price. It just feels too optimistic. And maybe it wouldn't feel that way if I had a deeper understanding of e-commerce. But I just don't have a ton of insight into that world and certainly not enough to be comfortable underwriting the necessary growth to justify Shopify's current share price as is implied by maybe a reverse DCF that you might do on Shopify to look at what the market kind of expects. In my bull case, I could maybe imagine the company growing at 30% a year for 5 years and trading at an exit multiple of 33 times operating profits in 2029. And still, my price target for the company would come a few dollars short of current prices. So like I said, even me trying to intentionally be as bullish as possible, I can't quite recreate the market's bullishness on this company. And 30% revenue growth per year is more than what most analysts are projecting. So this isn't just bullish, but this is like super bullish. And as I said, through that lens, the stock still does not look cheaply priced. So Shopify is an excellent business with so much potential, which is why the market pays a massive premium for it at around 54 times last year's earnings and 67 times free cash flows, which are numbers that make me blush. And so I just can't in good faith suggest that we add it. If you told me in 5 years that Shopify did actually grow 30% a year, I would not be surprised. But it's another discussion to have that as your baseline outlook for a company, which is what is implied at current prices. And I just can't get comfortable with that.
It's safe to say that it's never a good sign that your best case scenario ends up below the current market price. It's a prime example for a company that is priced for perfection. And that going into an environment that seems more uncertain than at any point since COVID. You had all the tariffs. Many economists actually expect to have a recession in the US. And we talked about how that would impact Shopify's business. So this just wouldn't be the time for me to buy a company like Shopify, which is priced for perfection.
And to say nothing either of the elephant in the room, though I guess it was maybe not an elephant in the room because we talked about it so much, but the competitive concerns with Amazon. And in short, I think Shopify and Amazon really are vying in different ways for the future of e-commerce. And what scares me is that Amazon might have some aces up its sleeve that it could pull out to damage Shopify further if push really came to shove. And one of those, which we've already seen, being the Buy with Prime initiative. If Amazon was not in the picture and it was this open landscape for Shopify to conquer, I could definitely get behind the company at these prices. But Amazon just adds a layer of competitive uncertainty on top of the tariffs and economic concerns that just really make me hesitate about some of the more optimistic projections of what Shopify can accomplish. So I am recommending we hold off on Shopify, ironically, as the person who's pitching it. But if we get a price south of maybe $60 per share, which would be a considerable discount from where the market is currently trading, it wouldn't be an unprecedented sell-off for companies with a stock as volatile as Shopify's, but it would have to take something like that, like a 30% or more sell-off, maybe even a 40% sell-off, for me to really seriously revisit the decision to add Shopify to the portfolio.
The value investor in me wants a 40% sell-off. I mean, the good news is that Shopify has been incredibly volatile. So there is a pretty good chance that at some point we will see those prices again. And the good news is that after today's deep dive, I think you gave such a good idea of how Shopify operates as a business and how secure it is from a long-term perspective. So perhaps there is a recession coming and the stock price would drop dramatically. And I think both of us would have enough conviction now to probably use that stock price drop to establish a position. But buying a company as richly priced as Shopify and seeing all those looming risks, mostly Amazon in the long term and short term, perhaps some macro concerns, it just doesn't feel like the right time to add Shopify to our portfolio. So it's a hard rating for me as well.
Okay, well, we're in agreement. Maybe just to wrap things up today, I'll give us a quote to reflect on. And then Daniel, if you just want to quickly give us a few hints on what company you'll be pitching next week, that'd be great. So here goes the quote from Amazon's Jeff Bezos, who says, "If you are competitor focused, you have to wait until there is a competitor doing something. Being customer focused allows you to be more pioneering." With Shopify, you could say they're merchant focused, and that has taken them a long way too. So Daniel, how about you tell us about your company for next week?
I've given these hints some thoughts, and it was not easy since I felt that all of them make it too easy. Perhaps I'm on the other side now where it's just too difficult to figure them out. If so, I will apologize in advance, but here we go. So the first one is that just like Shopify, my next company wanted to expand its business. And to do that, it tried launching a hotel booking platform, but it shut it down within a year. So there's a close resemblance to the logistic business of Shopify. The second hint would be that while the company is by no means an M&A business, it did make some acquisitions, and one of them was a small internet movie database in the late 90s. And then last but not least, it has been a pioneer in its space, and it inspired similar businesses on pretty much all major continents and big countries. So I think that's where I will leave it. Some people might be surprised when they see the company, but those are my hints.
Okay, those are some very thoughtful hints, Daniel. Thank you. I don't know if I have an answer for you. I'm not sure I have a guess, but if anyone in the audience does, they can always leave a comment and let us know what they think it is. And with that, I hope to see you all back here next week for another company breakdown, evaluation, and then decision on whether to add this mystery company to our intrinsic value portfolio. We'll see you all then. Coupang has, in short, captured the hearts and wallets of nearly every household in South Korea in less than 15 years. Partly that comes from succeeding so well in adjusting the Amazon online retailer model for the customs and preferences of South Koreans. Additionally, it helps that internet usage is so common in the country, with 97% of the population using the internet compared to just 78% in China. E commerce is a natural part of life in South Korea's densely populated cities. Where e commerce represents about half of all retail sales in South Korea, the number is only 16% in the US. So, like I said, e commerce adoption in the country is just very, very high. Behind this vision is Bom Kim, who moved to the US as a child and later enrolled in Harvard's MBA program before deciding to chase something even more ambitious.